I'm Joe Crump, and I got a question recently. How much money do you need to start investing in real estate? Everyone starts their real estate investing career thinking that if only they had enough money to invest, they could get filthy rich as a real estate investor. It's kind of true, but they think that the toughest part of this process is coming up with the money. But the money is always secondary to the deal. If you have a good deal, the money is easy. The hard part is finding the best deals. We'll cover that in a different video. Today I'm going to focus on how much money you need to invest. I'm going to answer this question by asking 5 questions. The number 1 is, do you have money to invest? They say you need money to make money, but I say if you can't make money with no money, you sure can't make money with money. If you have a good deal, money is always close by. Doesn't matter if you have money. What matters is that you have knowledge and skill. If you understand how to structure a deal properly, you can do it without any money of your own. In fact, you can close a deal and get paid the day you close and purchase the property. So it's not just no money down, you actually get paid to buy. You also don't need to use your credit to invest. Most of my portfolio has been purchased without using my credit. Most of my portfolio has been purchased where I got money at closing. But at some point, you start making enough money that you have extra money to invest. And some of you are working at high-income jobs or have inherited money that you need to invest, but you don't have time or energy to learn how to build a real estate investing business. So the short answer to the question of this entire video is you don't need any money to invest. If you want to find out how to do this without a dime, I have a 6-month mentor program where I walk you through the process and help you get your business set up. You can find out more about it at zerodowninvesting.com. But let's go deeper with the rest of my questions. The second question I would ask is, what kind of investing would you like to do? Short-term flips or long-term holds, and why? A short-term flip is where you get control of a property and then turn it around and sell it within a few weeks or months for a quick profit. You're in and out of the deal, and then you move on to the next one. The amount of money you need to do a short-term flip depends on how you structure the deal. The first structure I teach my mentor students is called the for rent method. I show my students how to get control of a property with a single-page document. Once they have control and become a principal in the transaction, they turn around and sell it for more than they paid for it. The difference between what they bought it for and what they sell it for is their profit. They aren't fixing up the property. They don't have to purchase and close it before they sell it. They don't even have to buy it below market value. All they're doing is finding a new buyer for the property at a higher price and selling it on a lease with an option to buy. That, by the way, is the reason they can sell it for a bit more than market value. You're selling it with seller financing in place. So it's similar to wholesaling, but it isn't wholesaling. No one has to come up with the full amount of cash to purchase the property. That means there are a lot more potential deals and a lot more potential buyers for these kinds of deals. Another way to flip property is the fix and flip method. You can purchase the property with seller financing using one of the zero-down structures that I teach. You can learn the 5 zero-down structures that you need by watching this video here about the hierarchy of zero-down structures. Most flippers and rehabbers will purchase a property outright, using either a loan or their own cash. This requires a higher level of risk, but it does not require seller-carried financing. It also requires that they purchase the property substantially below market value, so the seller gets less money for their house. So a flipper rehabber's cost in the deal will be the down payment or the purchase of the property plus the cost of the rehab and then carrying costs until they get it sold. Once they get it sold, they're out of the deal. Hopefully, if they did it right, they'll get their money back plus a profit. I can't tell you how many of my students have done flip deals before they started working with me and lost money. If you are going to put your cash or credit on the line, you better know what you're doing. One of the best ways to learn how to spot an actual good deal is using seller financing instead of conventional loans or cash. Working through the financing like this shows you in great detail if the deal makes sense. Once you've done a few of these deals, it's less likely you'll screw up a rehab project. So that's short-term flips. The other option is long-term hold. Long-term hold properties are what'll make you rich. If you wait, you will win. If you're building a real estate business from scratch, you first need enough money to live on so you can replace your job and do this full time. Once you've accomplished that and built your business system up so that you have consistent deals coming in across your door, then you can start holding on to the properties that you buy. So instead of a quick flip, you purchase and then hold that property for the long term. The other reason to do long-term deals is if you have money to invest and you know what you're doing. But honestly, if you have money to invest and you buy a property and hold it long term, as long as it's managed properly, you'll probably make money. The goal is to optimize that investment so it makes the most money possible. You can also bring someone in to help you invest. We have a turnkey package where we help investors buy properties. We do everything from finding you the property to financing it, to fixing it, to filling it and managing it. You can find out more about our Done For You program at jr4.co/doneforyou. The third question is, do you want to do passive investing or active investing? Passive investing is where you don't do anything except collect a check. It's like investing in the stock market. You put money in and you hope more money comes out. Most of my investing is passive these days. I've built a portfolio over the years and I have it professionally managed. So all I have to do is look at the monthly reports as they come in and watch my bank account grow. Once a year, we do an analysis of the portfolio to see how the properties have grown in value. My CPA also shows me my depreciation and the tax deductions and benefits that I get from owning those properties. So I get monthly income, appreciation of the property over time, depreciation benefits from the IRS, and if I have a loan on the property, I also get buy down on the note every month. If I have a lease option tenant in the property, I'll also get a few $100s a month in down payment assistance income. I've talked about this in some of my deal dissection videos I've sent out in the past. You can watch one of them here for more details. There's a link at the top. Passive investing is perfect for someone who has a lot of money to invest but not much time. But it's only perfect if you have someone who manages your properties properly. I've seen a lot of turnkey packages and property management companies that do not perform. I've also seen them sell deals that don't make sense. The best way to tell if the company you're hiring is any good is to find out if they have any successful clients. If they don't, there's a good reason for that. In this business, it's all about the outcome. If people aren't having a positive outcome with a company, or if they seem like good people but just don't have the experience, there's a very good chance that you won't have a positive outcome either. Here's an example of what success stories should look like. Here's a link, jr4.co/case study. We have hundreds of these detailed video interviews with our clients, many of them who are now millionaires and multimillionaires. The proof is in the pudding. Make sure whoever you hire to build your portfolio has proof. The next question we need to ask is, how are you going to finance your investment? Loans, seller financing, private money, partnerships, retirement accounts. There are a lot of different places you can find financing for investment properties. Most people think conventional loans are the obvious choice. Conventional loans require the borrower to qualify with good credit and income to support the loan. There are loans that base the qualification on the income of the property rather than the borrower, but they still require good credit and a personal guarantee from the borrower. There are also loans that don't require much down payment. FHA and VA are examples of this. But those loans are typically for owner-occupied properties, properties that you're going to buy to live in, not investment properties. Most investor loans require a minimum of 10% down, and most I've seen these days require 20 or 25% down, depending on the qualification of the borrower. Also, as a rule of thumb, put aside an additional 5% to cover the loan costs and points of those loans. If you have money like this to invest, it can be very profitable if you have a deal that makes sense. Here's a video that explains how to make money if you have money to invest. It breaks down the numbers in great detail. jr4.co/done-for-you. We use loans like this for our cash investors so we can leverage their investment 4 or 5 times what they could do if they invested money in the stock market. That's how we're able to get a 30 to 40% or higher return on their investment capital. These numbers sound unbelievable until you look at the math, and that's all it really is, math. It doesn't lie. Watch that video I just showed you. It's got the breakdown and how that math works. My favorite source of financing is seller financing. The seller doesn't have to come up with any money for you to finance it through them. They just need to allow you to make payments to them over time based on their equity and the loans that they already have. Or they can allow you to take over existing loans that they have on the property. We call this buying subject to or buying with a multi-mortgage. Seller financing is often the least risky form of investing. You have no money into the deal, you have no credit into the deal, and if you set it up right, the lender won't have recourse against you for a deficiency judgment if you default, which is highly unlikely to happen if you set it up right in the first place. Another great source of financing is private money. You probably won't do this until you have a really good handle on how to invest and make money, but once you do, people will start to offer you money to invest for them. Private money is a great way to give them secure investments that you manage and make a profit from. We talk about seller financing and private money in my mentor group. And if you have private money that you want to invest, get in touch. Crump at joecrump.com. Just let me know, and we'll set you up into a deal that makes you a great return. You can watch a video about that 6-month program that I do with my mentor students at zerodowninvesting.com. Partnerships can also be another source of financing. I've done this with my students. One person finds the property, the other person invests capital to purchase the property. Whenever you create a partnership, make sure everything is in writing and there's a solid exit strategy for when the partnership is going to end and how it's going to be divided. With the right people, partnerships can be wonderful. The last source of financing is retirement accounts. You can move your 401k into a self-directed IRA. That'll allow you to invest in real estate and have checkbook control. I suggest you set it up as a Roth IRA, which is after-tax investment money, versus traditional IRAs, which are before-tax money. One of the restrictions when using your IRA is you have to be careful what type of loan you use to purchase the property. To use IRA money to invest, you need to get non-recourse loans. These loans cost a little bit more and require a bit more down payment. You can also find partners who have retirement accounts they need to invest. If you have good deals, this could be a match made in heaven. So, as I said earlier, the financing is not the problem. The problem is finding the best deal possible. If you pull that off, money will always follow. The last thing I want to discuss is leverage and how it works. Leverage with real estate, you can control 4 to 5 times the assets you control in any other asset class. How does this work? No other investment class allows you to leverage as much as real estate. When we do seller financing, we get infinite returns on our money because we have no money invested. We actually get paid to buy. That's the ultimate leverage. But even if we put 20% or 25% down on a property, it still allows us to buy 4 or 5 times as many properties for the same capital investment. Here's a video where I break down the difference between buying a property with leverage and buying a property with cash. The difference in return on investment is dramatic. Leverage is absolutely my favorite thing about real estate investing. With a big enough lever, I can move the world. All right then, there you have it, a complete 30,000-foot overview for where to find money for your investments. If you found this video helpful and would like me to make more of them, make sure to give it a thumbs up and share it with anyone who might benefit. Please don't forget to subscribe to our channel below for more tips and strategies on real estate investing. You can also subscribe to my free email newsletter. I send out information, tips, and deals to this list that I don't send out to anyone else. Just go to my blog and sign up at joecrumpblog.com. When you're on my blog, you can also explore 1,000 training videos I've created, and it's all free. I've been doing this for a long time. You can also watch a few hundred case studies of my past students, many of whom are now multimillionaires. They don't tell you just how wonderful I am. They tell you how they made money, how they structured their deals, how long it took, the struggles they faced, the successes they had. They always inspire me, and they make me remember why I got into this business. One last thing I want to leave you with as a real estate investor. You should always try to be the most ethical person in the room. Take care of your buyers and sellers and employees like they were your family. Take care.